Joining us right now, Mr. K. Subramaniam, ED at Union Bank, and we also have with us V. Srinivasan, ED Corporate Banking at Axis Bank. Mr. Srinivasan, let me start off with you first. The RBI's cut of MSF rate, do you think this move would ease liquidity quite substantially?
No, I think it's not liquidity clearly is going to improve on the back of the additional variable rate repo which RBI has introduced. Other than that, the most significant impact has been the lowering of the MSF and therefore the lowering to some extent of overnight rates and correspondingly cost of funds for banks.
What do you think will be the immediate impact in the system when as a system to the short end of the rate and to the call market?
Clearly, that comes down to closer to the MSF rate. So you are seeing that 50 basis points reduction in terms of overnight and short-term rates, and that is the immediate short-term impact. And as the RBI has been indicating, they would prefer a steeper curve, and that is what they're working towards. You're seeing the short end coming down much more, and you will see a steeper curve as we go ahead.
Mr. Subramaniam, just want to get you into the discussion as well. Would banks like you keep your base rate still unchanged? And how do you see the MSF cut really impact your margins?
See, the banks which are borrowing, we have been borrowing very little, and then when you borrow, you are definitely borrowing, costs will come down. Other than that, there is no reason for reduction in base rate immediately unless there is policy rates are reduced by Reserve Bank of India.
Mr. Srinivasan, so what should market participants focus on? Should they focus on the repo piece more, or should they focus on the MSF piece more? Because currently the hike in repo rate and cut in MSF, they are contradictory in nature.
I think the immediate cost of funds for banks is to a large extent driven by the MSF rate. The incremental cost of borrowings to some extent will be dependent on the MSF rate, and that to some extent will decide the overall cost of funds for banks, and therefore in terms of lending rates that will be a bigger driver of lending rates than possibly the repo rate in the current context.
Mr. Srinivasan, the difference between MSF and repo is now 150 bips, and the RBI has said that it will bring down the gap to 100 basis points. How do you see then the MSF cuts going forward, and how much of a hike do you see on the repo, if at all?
We need to wait and watch. I think the inflation numbers are due over the course of next week. We need to see how exactly they pan out. We also need to see how exactly the currency behaves as we see some amount of volatility in global markets, as we look at the U.S. shutdown and possibly the overall in terms of how exactly that also plays out. So the volatile period is still not over. We need to see through this period, look at the inflation numbers, and possibly towards the end of the month at the time of the policy is when we can have a much clearer view in terms of how exactly repo and MSF will move further. But as of now, I think looks like the MSF, the short end is something which can go softer as we go forward.
So what is Axis Bank's dependence on the short end of the market, which is broadly the wholesale end of the market?
I think whether it is wholesale or retail, I think clearly the MSF will have an impact in terms of cost of funds. It's not only the wholesale borrowings which are impacted by the MSF rate cut. So to that extent, I think other than CASA, rates will move in tandem with how exactly MSF rate moves in the days ahead.
Mr. Subramaniam, let me ask you a simple question just for the benefit of our viewers. There was a fear that after the Reserve Bank of India policy, home loan rates, car loan rates, personal loan rates will go up. Now, after the MSF cut, can retail borrowers be reasonably assured that rates in the system are unlikely to move up?
I think they have reason, because with an indication that the MSF rate will further come down by 50 basis points, I'm sure with the cost of funds coming down for the banks, there is reason for the retail borrowers to reasonably expect for reduction in rates.
Srinivasan, let me also hear that from you. What is your take on the way how interest rates are moving in the system? Because there was a huge fear amongst retail borrowers after the credit policy that home loan rates, car loan rates will go up. After the MSF cut, can a retail borrower be reasonably assured that rates in the system are unlikely to go up? The EMIs will not pinch them?
I think that's a fair assumption to make, considering the trajectory of rates in terms of lowering of MSF rates and cost of funds for banks. One can safely assume that lending rates are unlikely to go higher in the short to medium term.
Final word from you, Mr. Subramaniam. Bond yields surely have come down. The short end of the market also has cooled down significantly. What will happen to your treasury operations because of what has happened to the short end of the market and to the 10-year paper?
I believe 10-year papers, in fact, already are softening the rates. So that should help reduction in depreciation of for the treasuries. And that should improve their profits also.
Okay, Mr. Subramaniam as well as Mr. Srinivasan, good having you on the show and good to get perspective from you guys. Thanks as always.